Hey guys, I'm Annie from FxScouts. Now, we all know that in order to make money on the Forex market, you need to follow the big money. In other words, you need to follow the market participants that move the markets. Understanding how they move price and what it looks like on the charts will transform your approach to trading. Before we jump in, just remember that Forex trading is risky and that most traders lose money. This video is for educational purposes only. Forex was initially intended to be used by banks and big institutions, not by us little folks or us retail traders. And until the late 1990s, only these big guys could trade Forex. The initial requirement was that you had to have $10 to $50 million to start trading. However, because of the rise of the internet, Forex brokers now offer Forex traders the opportunity to trade on the Forex market. So who are these key players and what do we need to know about them? Well, firstly, we have central banks. Central banks are known as the puppet masters of the Forex market, and they include the Federal Reserve of the US, the Bank of England, the European Central Bank, and they manage monetary policy, regulate interest rates, and influence currency valuations. They basically intervene when exchange rates need realignment through massive buy or sell operations. For example, in July this year, 2024, the Bank of Japan spent 53.5 trillion yen or $36.8 billion to shore up the yen. This followed warnings by the Japanese authorities to step in should the excessively volatile currency markets continue as they were. This intervention came shortly after the yen fell to a 38-year low against the dollar. And look what effect it had on the charts. What you can see is an extreme downtrend following the intervention, and this continued roughly till mid-September. So as you can see, when the big banks make a move, everybody pays attention. Next, you get the Superbanks, and these are commercial banks and institutions that dominate the Forex market, determining exchange rates and providing liquidity. And the biggest banks include Deutsche Bank, UBS, Barclays, Citi, HSBC, Credit Suisse, Goldman Sachs, and Morgan Stanley. These market participants contribute to 80% of the total Forex trading volume, which means that they have an absolute majority and can easily move and manipulate the market price. The same is true for other instruments. They don't just dominate the Forex market, they also dominate the stock market, the crypto market, the indices market, and commodities. So as you can see, retail traders like us make up a very small fraction of the Forex market, which means it's very difficult for us to move or manipulate price. But we can still be profitable. And we can only be profitable if we read the signs on the charts as to what the institutions may be up to and what they may be doing. With that said, you obviously want to know, how do we track their movements? Well, the easiest ways to look at their movements is through price action and volume. These are the two main things I look at when I'm trying to figure out what these institutions may be up to. So starting with price action, there are three main signs of institutional activity that you can look out for. First is sideways price action. Second is aggressive initiation activity. And third is strong rejection of higher and lower prices. In this video, I'm going to be talking about sideways price action and aggressive initiation activity. And in the next video, I'll talk about rejection of higher or lower prices. One of the biggest differences between retail traders and institutions is the amount of capital we manage. Because of this, institutions have a problem that we don't have, and that is trying to open a position without being detected. If they want to do so, they need a lot of time to open the trade. If they succeed, they're able to open their position without alerting other market participants or moving the price too much. They have to appear to be small investors opening a whole host of small positions. And the only way to do this is to slowly and discreetly open positions, causing sideways price action. Next time you see sideways price action, don't assume that nothing's going on. It could be these big institutions slowly accumulating positions. And it's also significant because sideways price action is where institutions are getting ready to make their big moves. So as you can see here, we have sideways price action and then a large drop in the price of the Euro USD. Now, if you look at the same chart, I've added the volume profile, and you can see here that the profile is the widest where sideways action occurs. And you can also see that volume profile works on all time frames. Here's the 30-minute chart, and again, you see the volume increases with sideways price action. After the sideways price action, you often get aggressive initiation activity, and this is based on a significant movement in one direction. It is caused by aggressive buyers pushing the price higher or by aggressive sellers pushing the price lower. And what happens is that big institutions are building up their positions in sideways areas. And then when they are done with that, they start aggressive buying or selling to manipulate and to move the price in any direction they want. This is how they make money. They slowly accumulate positions and then they push the price in one direction or the other to cause a flurry of buying or selling depending on which way they want it to go and start a trend and then take their profits. And this is so important because it shows us the intention of the big institutions. During the sideways price action, it's very difficult to know which direction they'll go. But with the aggressive initiation, it's very clear to see. So if there's a strong uptrend after a sideways price action area, then we know that the positions that the big institutions were accumulating were long positions. If, on the other hand, there is sideways price action followed by aggressive sell-off or a downtrend, then we know that the accumulated positions were short positions. Remember that aggressive buyers or sellers always cause strong trend movements or fast price movements. It is the aggression of these institutions that moves price up or down. Thanks so much for watching. I hope you found this video helpful and it's given you a bit of insight into how you can spot what the institutions are doing. If you have any questions, please don't hesitate to contact us. Our website is FxScouts.com. And please remember to subscribe and like. As I said in the next video, I'm going to be talking about the rejection of strong low and high prices. So please keep an eye out for that one.